Funds have long been a preferred method to raise capital for multiple deals simultaneously because they simplify the process for fund managers and investors alike. The drawbacks are startup costs for managers and a significant lack of control for investors. Not today. In today's show, we'll discuss how investors can pick up and choose which deals they want to participate in and determine how much capital they want to allocate to each deal. Or if you're thinking of starting a fund, here's a way that you can do so for half the cost. Gotta like that. Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. All right, here we go, everybody. Hello, everyone, and welcome to the Greater Central Florida Multifamily Investors Group meeting, where we focus on investing where it makes sense. I'm your host, Ismael Reyes. And in this group, we learn from and help each other invest in multifamily with a focus on Greater Central Florida assets or potential investment partners. On to today's topic. So let's welcome our guest speaker, Badri Malynur. How you doing, Badri?
Hey, Ismael, good to have you. And that was such a great introduction and such a great summary of our value proposition. I think I'm done. So
no. So you see, we've got folks here that are some of my partners are here, and we are looking at getting this thing kicked off with you. So this is not only an opportunity for the rest of the show, but it's an opportunity for me and my partners to really ask some tough questions here. Not to put you on the spot, but this is part of our due diligence. If you speak,
absolutely,
two in one. You know what I'm talking about.
I like it.
So Badri is a co-founder and VP at Avestor Inc, a technology platform focused on an end-to-end solution for sponsors to build private funds, customizable private funds. Badri has extensive experience spanning large variety of assets, including real estate, stocks, bonds, cryptocurrencies, commodities, options, and angel investing. Whoo, that's a mouthful. Okay, and that means he knows a lot. He has co-founded 2 startups and has extensive management experience leading large teams at a Fortune 500 company. He has an MBA in marketing and finance and a master's in computer science. Badri, it's a pleasure to have you on the show. The floor is yours.
Hey, thanks a lot, Ismael. Good evening, everyone. I think I can safely say good evening. I mean, regardless of where you are. So yes. To be here. I want to make this as interactive as possible. Yes, I have some slides. So I really encourage you to just type in the chat window or basically ask questions as we go along. Unmute yourself. I absolutely don't mind if you interrupt. I don't consider it an interruption. If you have some questions, just interleave or interject as we go along. So let me go ahead and get started here. I am going to not put this in presentation mode because sometimes I skip past some slides and I go back and forth. Just a very brief introduction. I know that Ismael gave a great introduction, but I kind of like to keep things light, show a few pictures. No, I promise this is only, I'm not going to show you my entire family album here. So like Ismael said, I love investing in startups. I've invested in about 35 startups. My goal is to visit every country in the world. That's my goal. I don't know if I'll quite get there. I'm up to about 65 countries, quite a lot more to go. Based in Portland, I'm a huge duck fan. I know they didn't do that well this year, but we won't go there. And I did run a hedge fund trading stock options, and I love hiking. I've hiked in all the continents, and I also love skiing. So, and some pictures of my lovely family, but that's not what you're here for. So what I thought we could do is talk about, now we can debate if we are in a recession or not. I obviously want to talk about customizable funds because that's the unique thing about Avestor. But before we go there, I want to talk about how investors behave in a recession. And we'll look at some capital raising options. I know Ismael gave a great introduction. You can do syndications, SPVs, funds, fund of funds. talk about some of the pros and cons of the different trade-offs of doing one or another. Then we'll obviously talk about customizable funds and stop with this quick overview of the Avestor platform. Yeah. So how do investors behave in a recession? Well, let's not get into this big debate of are we in a recession or not, shall we? I mean, things are slowing down. Can we agree on that at least? If that you don't think they're even slowing down, then tell me where you live. I'll come and invest in your state. Yeah, I mean, I think we all agree in most states things are slowing down. Investors behave a particular way during a recession. They're seeking safer investments. They want to increase the amount of passive income. Maybe they're not sure about the job. They want to have some backup income going. And here is a very important distinction. I know many of you are used to selling investors or even investing also one deal at a time. But investors are scared to make single large investments. I mean, how many of you really feel comfortable about asking for or investing $50,000 or $100,000 per deal? I know we do that, but if you had a choice, is that what you really want to do? They want to seek more diversification. They want to build a portfolio with multiple points of liquidity. That's always a good thing, right? I mean, you think you don't need the money for 5 years, but hey, I don't know, 2 years from now, something may happen and it'll be nice to have multiple points of liquidity. And they're very, very sensitive to expenses, okay? Given that background, I think most people would agree with this. It's not very controversial, I would think. Let's kind of get into what are some of the ways to raise money during these times. And when I say capital raising options, these are also investing options. I mean, it's, the heads and tails of one coin, right? So these are capital raising options for people who are doing their own deals, but these are investing options for people who are investing in various deals, right? So being an engineer many, many decades back, I still have to go back to the x-axis and y-axis, right? So x-axis, a number of deals, y-axis, the ownership. The simplest and things which most people are familiar with is a syndication deal, where it's one deal, you own the real estate, or it could be one deal where you don't own the real estate, but you invest in real estate. How many of you, these are for the capital raisers in the audience, right? I mean, how many of you want to do capital raising in addition to doing their own deals? Just type in your chat window, I guess. Or people are really just interested in doing their own deals. I mean, many of you are interested in a capital raising too, right? So an SPV is something you create, a special purpose vehicle where you create one entity for every single deal you're investing, not very scalable. Syndications also not very scalable. If it's okay to do 1 or 2 syndications, but if you do 5, 10 syndications, you have to do separate blue sky filings, you have to do separate LLCs, separate PPMs. I'm going to rattle off all these terms. I know Ismael runs a good group. By this time, I think you'll know what a PPM is, right? Private placement memorandum, the thing which you sign, the 50-page horrendous document, which, I mean, unfortunately, we have to sign for every single deal, right? Or you could do a fund where a fund owns multiple real estate deals. Again, the key is owned, right? It's in this axis. Or a fund of funds, which is what I'm going to talk about. And not only any fund of funds, but a customizable fund of funds is what I'm going to talk about. A customizable fund of funds gives you, a fund of funds in general and a customizable fund of funds in particular gives you a lot of flexibility because you not only can invest in multiple deals, you can own multiple deals, you can invest in multiple deals. It kind of combines all these segments, yeah? I won't spend too much time on this because a lot of you may be doing your own deals, maybe some of you are investors. But in general, the main advantage of a syndication deal is that you have full control of the asset. You're limited to one asset. It's simpler to execute, and both SPVs and syndications. The main advantage of a fund is that you can have multiple assets and you can separate out the fundraising from the asset. And the fund of funds, you can do both passive and active investments, and you have massive investment flexibility. And I'm going a little relatively fast. I'll spend more time on the later slides. The disadvantage is for syndications, how many of you have actually done a syndication? Who likes this mad rush? Oh, you have 2 weeks to raise the money. Otherwise, your hair is going to catch on fire kind of a thing, right? Nobody likes that. And you have to do a separate one for each deal. And like I said, it's okay if you're doing 1 or 2 syndication deals, But can you imagine doing 10 or 5 a year? Or if once you do 20, 30, at least then you'll become like me. You'll lose any hair which is left on your head, So, and a fund, one of the problems with the fund is there is less transparency. Ismael hit the nail right on the head. Investors don't have a choice. They have to invest in every single deal. And the regular fund of funds has the same disadvantage, right? I'm not talking about a customizable fund of funds. And again, you don't have control over the asset and less transparency, right? So in general, before we talk about fund of funds and customizable fund of funds, what we feel is there is kind of a migration towards the right in times of recession. Let me tell you why. Because you have as a sponsor or a syndicator, you have more flexibility. You're not tied to a deal timeline. If a deal falls through, you still have the money sitting. You can go on to your next deal. And I told you, investors feel comfortable investing in a diversified portfolio. Diversification. I don't think any of you will disagree. No, we should not diversify, put everything in one basket, right? I don't think anybody says that, right? If they do, run as far and as fast as you can from the advisor. And more importantly, a fund allows you to become build more of an advisor relationship, as opposed to popping up every 3 months or 6 months and saying, hey, here is a deal. Hey, here is a new deal, which is even better than the old deal. You can take a holistic relationship with the investor and say, what are your needs? Are you looking for cash flow? Do you want to build more? You want to save on taxes? Do you want more capital gains? You can build up a portfolio relationship. And funds are a lot more cost effective than individual syndications. And remember, I told you in times of recession, people are very cost conscious. So you have the flexibility to create a balance of income and long-term capital gains, right? So that is the general fund of funds. But now let's go into the customizable fund. A customizable fund takes all the... by this time, I hope all of you have some feel for a fund, an SPV, a syndication. I know I went a little fast, but I'm sure you've heard this terminology before. A customizable fund takes all the features of a traditional fund and all the best features of a syndication and adds a few more good advantages and in one nice, very easy to manage package. Yeah. And I'll give you a demo and you'll see how that works. So what are some of the advantages from the traditional fund? A traditional fund, you have 1 ppm. Now, I don't know how many of you enjoy signing a 40, 50-page ppm for every investment you're doing. If you do, come talk to me and I'll give you some legal documents for you to review in your spare time, right? So you can raise money continuously, earnings can be reinvested. That's a nice advantage. For example, we run a fund where people just put in 5 or 10,000 every month, whether there is a deal or not. They know that we offer a steady stream of deals. And then they get to pick and choose which deal they want and say, okay, remember that 10,000 which I put in, well, put it in this deal, And then they have all the advantages of the syndications. Investors can obviously, in a customizable fund, choose which deal they want to participate in, like a syndication. They get all the tax benefits and depreciation benefits. It flows through dollar for dollar. On top, now, after combining all of these advantages, we add a couple of new advantages. Customizable funds gives you massive business model flexibility. What I mean by that is, can you imagine a blind fund where investors have to invest in every deal, which doesn't have a strategy? Good luck with that, right? Go to an investor and say, hey, what does your fund do? Oh, I don't know. It might do anything, but don't worry about it. Just give me a check for $100,000. Good luck with that, right? How will that work? Most people in a blind fund, you need to have a very well-defined strategy. Maybe it is storage facilities in the Midwest, or maybe it is, hey, you guys are in Florida. Why am I going to the Midwest? Sunbelt states and multifamily in Florida, or multifamily in Orlando. No, that might be too narrow a niche, but you need to have some strategy, right? But in a customizable fund, you don't need to do that. You can, if suddenly somebody comes along and says, here is a really nice storage deal, and you have never done a storage deal, you can still put it in the fund. And you're not going to piss off the investors who invested in the beginning saying, hey, you never said you'd get into a storage deal. If they don't want to go into the deal, they don't have to, because they're picking one deal by deal. And by customizable funds are by far the lowest cost option, period, full stop, because you have one PPM, you have one blue sky filing, less accounting, less taxes. It's a far more streamlined process. Yeah. So what is, let me pause here and see if you have any questions about a customizable fund and a fund and syndications, and any comments really. Do you agree with the behavior I'm predicting as you know, I don't know if we will have a recession, but as times get tougher? Any questions about anything I've said so far?
I have a quick question.
Sure.
And I apologize for any background noise.
Oh, it's very clear.
Thank you. Good. If there's this ultimate flexibility, do you see any concern from an investor standpoint of not having the certainty of what they're investing in?
The urgency? Okay. So excellent question. In a customizable fund, you can still add a deal, one deal at a time, and the deal still has a deadline. So you can say, hey, I have this deal in a customizable fund, but the deal deadline is still 3 weeks or whatever the number of weeks are. And so you can still impose that urgency. That's a good question. But we also have this ability to backfill a feature. So even though you impose urgency on most investors, you can invest your money and then backfill and allocate it to investors. We'll talk a little bit about that. So, you know, we don't impose too much urgency because we build a long-term relationship with investors. But there are very often we do have deals where we say, hey, you have only 3 weeks to invest in, you know. So good question though.
So I have another question. Yeah, I have another question. So in the instance where you collect the investor funds and there's no particular deal to invest in, what's the benefit to the investor in just having their funds sitting there right now until a deal comes along?
Not much of a benefit, to be honest. I mean, there are some fund managers who offer special debt notes saying that, hey, while your money is sitting, we'll offer you some interest. We don't in our fund. It's up to you. If you create a fund on Avestor, it's up to you and what you want to do. The benefit is sometimes, you know, we also invest in deals which go very, very fast. For example, we invest in, I'm sure all of you have heard of CrowdStreet, right? I mean, where CrowdStreet, I mean, where, you know, it's the big gorilla where people, large sponsors, right, lots of money. Sometimes those deals go in 30 minutes, a couple of hours at most. And then we pre-invest in those deals. And then we put it on our platform. And in our platform also, it can go pretty fast. We prioritize people who have already cash in the account. That's one advantage. And the second advantage is it's just the dollar cost averaging, right? I mean, I've decided to put $5,000 a month in real estate, and it automatically goes there. And then they can come in and choose which deal they want. And the third thing which we do offer custom debt, not custom debt notes, but debt notes in our platform, in our fund, where they can buy slices of debt, but their money is still tied up for 6 months to a year. But in general, if you do take money in advance, it's really, you need to offer a steady stream of deals. With the Avestor customizable fund, it doesn't all have to be your own deals. We'll talk a little bit about that. We have a great mastermind. There'll be a lot of people pitching their own deals. I mean, these are only people who have created a fund on the Avestor platform. And we screen hundreds of deals, and a small subset of those pass our criteria. And we'll offer that to our fund managers. And we are not making any money out of that. They can go invest in that deal. So long-winded answer. If you keep it for a long time, yes, investors are going to be upset. But as long as you offer them a steady stream of deals, people like the idea of investing periodically. And people like the idea of having priority allocation when a hot deal comes along. So did I answer your question, Kevin? Kind of?
Yeah, thanks.
Okay. All right. Sounds good. So we'll have a lot of time for other questions too. Let me continue here. Avestor is a platform which brings together investors, sponsors, syndicators, whatever word you want to use, with, like I said, a customizable fund which combines the best features of syndications and funds. The way it works, you think of it like building an empty foundation. when you build an empty foundation, you generally don't know all the details of the entire layout, you know. You create one fund for all your deals. You can have multiple asset classes. You can add unlimited number of deals over time. You can add a deal within 45 minutes and an hour. Now, I challenge you to do a syndication deal within 45 minutes. By the time you get up and call the attorney, it's going to take 45 minutes. And then, they have to, you negotiate with them, and then they have to create the PPM, you have to approve it, and then go back and do the filings. I can't imagine doing a deal within less than 2 or 3 weeks, right? I mean, you guys tell me if you have done a deal within 45 minutes and you can't do that in regular syndications. Your investors choose which deals they want. We already talked about that. And you can raise capital 365 days a year. Now, you can't just keep the capital for 365 days and say, yeah, I've taken your money, come back to me in a couple of years, I'll tell you what deal I'm investing in. You can't do that. You do need to offer some regular deals. You can add any asset class in a single fund, even beyond real estate. We have people doing music streaming rights, judgment liens. We have people doing startups, venture capital, but anyway, we'll focus on real estate for now. But all assets of all categories of real estate. Airbnb funds, multifamily, self-storage, student housing, triple N leases, industrial, retail, everything, yeah? You can customize returns and promotes by deal. Notice that you can't, right? Because everybody picks their own custom portfolio. That's like saying, okay, I'll build a custom stock portfolio for you. What do you promise me as a return? I don't know. It depends on what stocks you pick, right? And you have the flexibility to be a GP where you're doing your own deals, a co-GP where you're raising money with others, or an LP. You may not make, I'll be the first one to admit you're not going to make as much money on an LP deal as a co-GP or a GP, but you can charge a wealth management or a fund management revenue, which is in addition to all the other money you make as a GP or a co-GP, yeah? One important point, people often compare us to, there are a lot of syndication platforms out there. Many of you would have used it. We have a very cool software platform too, but that's one small piece of what we offer. Don't think of us as just they offer a software platform. Yes, that's an important piece of what we offer, but just one piece. Think of us as an end-to-end offering where we help you market, launch, scale your fund. So, the other way around, right? Launch, market, scale your fund. You know what I mean. So we help you with your fund strategy. We have more than 50 funds on the platform. We have worked with a wide range of funds. We help you with all the legal and regulatory stuff where you don't have to go around, shop around with multiple people. We help you with investment management, investor management, compliance, accounting, taxes. So basically, when you work with Avestor, during the setup process, you get complete exposure to our full partner network. And I don't have to be a great negotiator if I have 50 funds and I have volume to go to an attorney, right? I mean, obviously 50 funds has more negotiating power than one fund. I mean, think of it like a Costco model. So we help you set up the legal entities, the fund entity and the fund management entity. We help you create a customized PPM based on what asset classes you're going after, do the subscription agreements, Reg D filings, Blue Sky filings. We help you with all aspects of the operations. The investment setup, you can add a new deal within 45 minutes or an hour in the platform. You can do investor onboarding. We do KYC checks, accreditation checks, and AML checks. Now you'll say, what the heck is an AML check? Well, nobody cared about it before the Ukraine war. And you're right, 99.9% of the time. But that 0.1% of the time, do you really want someone in a watch list in your thing? It's all instantaneous and all integrated into the platform. Yeah. And then we do all the financials and oversight, working with 2 top 20 accounting companies, reconciliations, income statements, tax calculations. And here is our crown jewel, if I may. Even if we have spent literally hundreds of thousands of dollars, so we'll call it a crown jewel, even if you don't like it. Even if your investors invest in 10 different deals and different amounts, they get a single K1. You know, folks, the only person happy getting 10 K1s at tax time is either you're kind of a sadist or you're a tax accountant. You're very happy if you're an accountant, you make more money, but nobody else wants to get 10 tax documents. So, I mean, it not only reduces tax prep costs, but it also has potential tax advantages. I can't promise you that. It depends on your tax situation. but you're continuously offsetting depreciation from one deal against another. So most people reap some tax benefits as well. So to recap, we are a turnkey solution. All operations are handled, including the initial legal setup. You don't have to go shop around to multiple people. You're welcome to shop around, but you won't find better rates than what we offer. Evergreen fund, once you create it, it's like, I don't know if you guys have seen that battery commercial. It keeps on going, that bunny thing. So once you create it, you can keep on going, adding deals, deal after deal after deal. Customizable, wide range of investment classes. You can do GP, co-GP, and LP investments, completely streamlined in terms of all the operations. You don't have to go to multiple places. And then this is a little geeky, so bear with me. We are the only platform in the world which will allow you to backfill your GP capital. What I mean by that is, let's say you're raising $1 million, even numbers. I know maybe you're raising 10 million, whatever it is. Let's say $1 million. You're 100K short, and you can close the deal, and somebody comes along and says, hey, Kelly, I like that deal which you did. Can I have $50,000 if you still have some inventory left? And you can take the 100K you invested, take 50K out of it and give it to that new investor. Now, that's not a big deal because other platforms do that because you get a portion of cash distributions. But we are the only platform in the world which also gives you a portion of the capital gains. What I mean by that is, so let's say that's a 5-year deal. Somebody comes in 6 months later and takes a 50K chunk. So 6 months divided by 5 years, it's roughly 10%. So we calculate the time value of money and you get 10% of the capital gains when the deal exits. So what that allows you to do is decouple closing a deal from raising money from investors and move some inventory capital. I mean, all of you probably, even if you're doing your GP deals, I mean, I'm sure you're doing some passive investments of your own. And in this case, you're investing in your deal and moving it from deal to deal and still getting every penny while your money is tied up. So let me pause here. There are two things I need to do. Talk a little bit about our fee structure and also give you a demo of the platform. But this is another good point to pause and see if you have any questions about anything I've said so far.
Badri, can people with crypto invest in this?
Maybe. Let me explain why. So in general, this platform is meant to be for private assets. Now, if you're taking a long-term view, we don't have a way to mark every day. I mean, crypto can go up and down every hour, forget every day. But if you're putting crypto in a LLC and slicing up that LLC, for example, we have a fund manager who's going to put some NFTs in a LLC, non-fungible tokens, and then slice it up and allocate it. But then it doesn't get a mark to market every day. So the answer is it depends. But we don't take custody of crypto. So, I mean, you need to have another platform which maintains the custody. All we do is kind of slice it up and allocate it to investors. So good question.
I have a quick question.
Sure.
Can someone invest into a fund using a 1031 exchange?
So many people ask that question. Unfortunately, no. We are still trying to figure that out. Not a fund, but in a fund of funds like this, the 1031 exchange rules are very restrictive. So for people like that, you can either I mean, there is a trust you can form, but in general, unfortunately, that's one thing which is not possible. We are still looking into it, but so far the answer is no.
Wow. Even if you're able to identify a property, you still can't do it?
No, because it's not a one-for-one exchange. In a fund of funds, you're investing in, it has the potential to invest in multiple deals. So you cannot do a 1031 exchange. But having said that, we have structures. So let me digress a little bit and go into some structures here. So how does this work overall? I'm digressing a little bit, but I'll come back to your question. So we create a customizable fund. And with that, we create the LLC docs, the PPM, operating agreement, subscription agreements, and everything else. If you don't know what they mean, don't worry, I'll explain it more later. And then we create a fund management LLC where 2 of you or 3 of you get together and join, are the fund managers for the fund. And then the fund investors come in and invest in the fund LLC. And the way it works is the fund LLC will invest, let's say, $500,000 a year, $500,000 a year. And then the fund will invest in multiple deals. And then the fund investors will come in here and they say, I want to put 20K here, 30K here. So we calculate how much they end up owning of the LLC. So maybe because of 20K here and 30K here, they end up owning 0.49% of the LLC, whatever it is, right? And then the fund manager can charge a fund management fee and they get compensated, the fund management. And if you are owning an asset, the fund owns 100% of the asset. And if you're doing your own deals, we still recommend you create asset LLC, which is a lot easier than creating an entire syndication. And then fund owns 100% of the equity and 100% of the distributions go in. But this is what I was getting into. So if you want a 1031, the 1031 investor can come in directly at the asset level. So the fund may own 75% of the asset and the 1031 exchange may come in at 25%. I don't want to confuse you with all the different structures, but we do accommodate different scenarios. But what the 1031 investor cannot do is come directly through at the fund level. So,
I got you. Yeah. Okay.
So yeah, so it basically it's a tenant in common is what it would be.
Right. He goes straight to the asset. He doesn't go through the fund. I got you.
Correct. Yeah.
Okay.
Because I mean, not that we don't want you to do that. We would love to have you do that, but it's illegal. So we don't want you to do that.
Thank you.
So let me go ahead and other questions before I move on? No? Okay.
I got a question, Badri, on
Sure.
the, so I saw that one of the structures you actually can have multiple fund managers as part of the fund manager entity. Is there a way to segment, where the money's coming from? For example, if I have multiple partners that I work with and we create a fund, and we want to structure the entity to essentially provide some sort of incentive for fund managers that bring in significant capital, right, onto this fund. Is there a way to do that? I'm trying to figure out how we would potentially allow people to provide that kind of incentive to individual fund managers within a fund.
Oh, within the fund, you want to give more money to one fund manager versus another. Is that what you're saying?
Yeah, based on how who they bring in and how much money they bring, how much capital.
All that can be done at the operating agreement of the fund level. So you can so a chunk of money goes from the fund to the fund manager. How that gets allocated, you can build it, make it as complex as you want, because that's at the fund manager operating agreement, not at the fund level. So the fund, maybe you charge a 2% fund management fee. That whole money is lying in the fund manager account. And then how you divide it up is completely up to you. You can go as crazy as you want. So,
but can you tag the money as it comes into the fund? In other words, can you tag it, associate it somehow to an individual within that fund manager?
It has to be done outside the platform. So we don't allow, the platform itself doesn't allow you to say this is the person who brought in the investor. But unless you have thousands of investors, it's even if it's dozens of investors, it should be easy enough. Say this investor came from him, so we'll give him some extra money. So
yeah, thank you.
Sure. So in terms of the cost, I don't know how much you pay for your PPMs right now, but typically people pay 10, 15,000 for each syndication deal they're doing. So for okay, there are two things I should tell. These costs are till the end of the year. It's not that we raise money every few months. We have not raised for more than a year and a half. The cost structure will go up by about $3,500 from January 1st. So today it'll cost roughly between $14,000 to $15,600. I'll tell you why. There is a range till January 31st. December 31st. So $9,000 for the complete legal solution, entity formation, PPM, subscription agreements, state level disclosures, and everything else. So this includes 2 LLCs and everything. This is a highly discounted rate, folks. I mean, we have negotiated because of the volume we provide. A one-time setup fee for $5,000 to Avestor. And then depending on the state and various the type of fund you're creating, you may need to be registered as an exempt reporting advisor. So for that, it's $1,600. So it's either $14,000 or $15,600. Yeah. And this will go up. The 9K goes up to 10K and 5K goes up to 7.5K from January 1st. Yeah. So apart from that, we have kind of a portfolio fee. We charge 0.5% of the assets under management up to $5 million. And 0.45 if your assets grow above 5 on the entire amount. It's not like income tax rates. So it's 0.45 on the entire asset. And then 0.4 if it grows above 10, 0.3 if it grows above 30, and no additional charges above $40 million. So it stays at 0.3 maximum. So now you might think, hey, that's quite a bit. But actually, if you compare doing multiple PPMs and multiple blue sky filings, and then doing multiple LLCs, and you're saving anywhere from 40 to 70% in legal, accounting, and compliance costs, and you're saving 70 to 85% in time savings. And there's a far more scalable way of doing business. Yeah. So, questions about this? Shall I go ahead and go into the demo? Yeah, let me go ahead and do the demo, and I'll come back to this. So the basic idea is you'll get your own branded portal, like all the other investor portals out there. Certainly hope you call it something more innovative than a demo fund, but that's what it is, a demo fund. And so you log in, and whenever you get confused about this, think about it like a stock brokerage account. We have tried to replicate the stock brokerage account experience for your investors. So you log in, you'll be able to see how the overall fund is doing. You'll see the account balance, the number of deals, return on deals which have exited, total earnings so far. And here is something very, very cool. You can replicate the stock bond experience for your investors. Remember what I said? It's about building a portfolio of deals for you. So you can do your own debt, or we can give you platforms where you can buy first mortgage liens offering 8 to 12%. And now you can go to your investor and say, hey, we can replicate what you're doing in stocks and bonds based on your age, your risk tolerance. So maybe you want to put 70% in syndication deals and 30% in debt, And then this is like a vanity map, which shows you how your deals are distributed. You can click on anything to get more information. And then this is a liquidity graph, which tells you approximately when you'll get your money back. Now, you guys know this as well as I do, that it's not guaranteed, it's a projection. And then just like a stock brokerage account, you'll be able to see how each individual deal is doing, not just how the overall fund is doing. So for example, this person has put 30,000 in this value add apartment complex. Sorry, I don't see anything in Florida, but these are all just examples. And he's made $600 so far. You can click on this and, you can upload any pictures or any PPMs or any project updates. And when they want to invest in a deal, that is not dissimilar to other portals out there. And when they want to invest in a deal, they simply go to the current opportunities page right there. And then they will see all the deals currently available in your fund. Now, if they like a particular deal, they'll say, click on this to get more information, and then say, hey, Ismael, Ray, why don't you offer, I'll put 20,000 in this, and we have a backend portal, which will allow you to allocate deals, onboard investors. And we offer you a steady stream of curated deals if you're not doing your own deals. I mean, it's getting hard to find good deals. So we have relationship with hundreds of sponsors. And a very important point is we try to bring the power of the negotiating power of the Avestor platform when we go to these sponsors who are looking for capital for their deals. And recently I negotiated a deal where the average retail investor gets a 50-50 split, and our fund of fund managers get a 90-10 split. So, I mean, it's not that I'm such a great negotiator. It's just that I have 50 people who are willing to raise money for this deal. And then suddenly now the sponsor is a lot more amenable to talk to you, So that's the basic idea. We believe this is kind of a game-changing platform in terms of how you can raise capital. Both this is game-changing not only from a sponsor perspective, but it's also game-changing from an investor perspective. Think about it. You go to one place, you can build a portfolio with multiple liquidity points. With $50,000, you can invest in 20 plus deals, which is in what they can do in a fund which we run, and similarly other funds. You can get a single K1. You get pre-curated deals, and you can invest in multiple geographies, multiple asset classes like self-storage, student housing, retail. So we believe it's kind of a game-changing kind of a platform. And the last thing I wanted to mention is we have a marketplace. When you create a fund with us, your fund is put in the marketplace. And already investors are coming into the marketplace, and funds are getting investors from our marketplace. But we are going to do a venture capital round 6 months from now, and then we are going to funnel a lot of advertising dollars to the marketplace. Now, I'll be the last person to say, come to us and we'll take care of we'll find all your investors for you. I'm not saying that, but it's always, think of any investors you get from us as gravy, So you're getting some additional exposure and investors. So in addition to a soup to nuts platform, we help you with all aspects of it, taxes, accounting, legal. We even give you marketing collateral to explain what a customizable fund is. We create a custom branded video, which you can kind of quote unquote send to your investors. And we help you, we kind of become your back-end business partners for launching, marketing, and scaling your fund. So that's kind of what I had. Happy to take questions.
Hi, Badri. This is Tim Little. I had a quick question.
Tim, we have talked in the past.
Yes. So you mentioned, you actually answered one of my questions already, which was the K1 piece. You just said that the investor gets one K1. I guess I'm just curious what that looks like from the investor perspective, especially if they're invested in multiple deals, 20 deals as an outlandish example. So what does that K1 look like from their perspective? So
we have spent literally hundreds of thousands of dollars and tens of man years of effort developing this. So excuse me if I feel a little proud of it. So what we do is you invest in a deal and that issues a K1. I mean, the deal K1, right? So when I say you, the Tim Little Fund has invested $500,000 and tax time, the sponsor gives you a K1, I hope. Maybe not tax time, but you have to do the file extension and all that. We have to go through all that. And then we take that K1 and slice it up into all the investors who have invested. Somebody has invested 10K. So we take that amount, slice it all up. And then one investor may have invested in 5, 10, 20 deals. We combine all the K1s. And then line item by line item is generated. But it's not like, oh, you have to take our word for it. You can go to the portal and they can actually see what line item got contributed and which deal contributed to the line item. Most people don't take the trouble of doing that. But if you want, you can do that. Did I answer your question? So you slice it up and then recombine it to generate a single K1.
Okay, so when they get it, it won't be reflected as all those little slices. It'll just be the single picture, basically.
Single picture, but if they want to see how that single picture came, they can log into the platform and see it. Most people don't want to.
Right. So. Understandable. Okay, no, thank you.
Other questions?
Badri, quick question on the on that. Just following up on that topic, is it a 1K1 per fund, or is it 1K1 per investor? In other words, if an investor, I'm assuming this is obviously not a white label site. You mentioned that an investor can potentially go in and essentially invest in somebody else's deal completely, right? They have that kind of option. But for the investor perspective, will they only get one so long as it's something within your website overall?
No.
Or is it
you
per
can't
fund?
legally do that, right? If they invest in multiple funds, they'll get multiple K1s. It's one K1 per fund, because legally we cannot give a K1 across multiple funds. But one thing I do want to make sure, your investor will not see any of the other funds, period. They have to consciously come to the website, they have to Google what Avestor is and come to the marketplace. In general, we believe that you'll get a lot more positive from the investors we attract, the general investors, than any of. I want to make sure you're not concerned that your investors will go to another fund. They will not see any other deals when they come to a portal. It's branded in your portal and it's branded in your name. But if they go to our website, go to our marketplace, but then they can find that anywhere else. They can go to CrowdStreet, they can go to any number of things. I just want to be clear on that. So.
No, that's good. That's good clarity, and at least to explain that. So that's good. And then as far as the portal itself, can that be customizable? In other words, if I want to have my ugly mug on the, as soon as they pop into the portal.
Absolutely.
Video
I mean,
or
all the logos and the colors, and I mean, it's on the top, and all that you can put your own branding, of course. So,
okay.
Kelly?
Are there, I apologize if you already mentioned this. Can you speak to whether it's accredited, non-accredited? Are there investment limits?
That's my oversight. I did not mention it. Let me talk about that a little.
Good.
Thank you. Thank you. I appreciate you bringing that up, actually. So you guys are kind of familiar with roughly a 506B versus a 506C, right? Let's talk at the deal level. A 506B deal cannot be advertised, and you can have 35 non-accredited investors. I think most of you know that. And a 506C deal can be advertised, but it can take only accredited investors. Now, let's extend that to the fund of funds. A 506, same thing, really, but with a little twist. A 506B fund of funds can take only 35 non-accredited investors and cannot advertise. It's similar to the deal. But the twist, and it can invest only in 506B deals, okay? Either it's your deal or somebody else's deal. But the twist is, once the 506B fund hits $5 million in assets, the fund itself becomes accredited. And then it can invest in 506C deals also. To repeat, once the 506B fund hits $5 million in assets, it can invest in 506C deals. So that's a little bit of a backdoor way of exposing 506C deals to non-accredited investors, which you cannot do in a deal by deal, in an individual deal. And the other point which I wanted to mention is, some people you really need to ask yourself as to, I mean, this is no different than your deal. Are most of your investors accredited? I know it's a tough decision, right? It's a little annoying. One wishes that there was a 506B deal which you can advertise, but unfortunately, SEC laws. You have to ask yourself, do you have more accredited investors or non-accredited investors? And we definitely recommend creating a 506C fund because it's more scalable. But if most of your investors are non-accredited, well, you have to do a 506B fund and try to build 5 million as soon as possible. Most people do one or the other, but some people in our platform do both. They've created both funds simultaneously. So.
And is there a limit to how much a, say, non-accredited investor can invest in a fund? I feel like I read something at some point that it depended based on their income.
No, there is no limit on how much.
Okay. Okay, so somebody could, if they're making 100,000 a year and they happen to have 100,000 saved, they could invest 100,000 in it. Okay, yes. Cool.
Yes. Now, there are some new laws which are coming. We don't know. I mean, who knows until that comes, right? Where they're talking about limiting how much you can put in a single investment and things like that. But nothing has come through yet. So.
Hi, Badri. This is Vesi.
Hi, Vesi. It's been a while. How are you?
I'm doing well. How are you?
Good, good, good. Busy. Funds are coming off from all directions at us, which is a good thing. I'm not complaining. I'm not complaining.
Yes. One question, and feel free to dismiss it if it's out of scope, but curious how redemptions are handled within the fund.
So when you say redemptions, investor asking for money back, right?
Correct.
So, not money back, money which comes in. You can't say, sorry, I changed my mind, give my money. You can't do that.
Right. Money that comes in and whether or not that will be back.
That's a great question too. Perfect. I mean, I think all these questions lead on and kind of have a comprehensive whole, which is very nice. So think of the analogy of a stock brokerage account, right? I don't want to beat this to death, but it's the best analogy. What happens when you get dividends? It just gets added to your cash balance. Same thing happens. There's a virtual cash balance when a deal comes or a deal gets done too, a deal exits. All that money is put in the investor's virtual cash balance. And we intentionally do not put it in their bank account, but they can link their bank account. They have to come and ask the fund manager's permission to, approval to take that money out. And that's intentional because that's your chance to hit them up and say, You really want to take the money out? I have this other deal coming up, right? And if they still want to take the money out, we have ACH integrated into the platform and they can withdraw the money. So any money comes in, by default, it goes into their cash balance and they can wait until it kind of adds up a little bit, and then they can decide if they want to invest in a new deal or they want to withdraw the money. But let me tell you an interesting stat. We have our own fund, which we built to test out the platform. When I say test out, it's a real fund. Don't get me wrong. It's not a software test or something. Less than 2-3% of the money gets withdrawn. Even when deals exit, people just leave it here. It's human inertia. I think all of you would agree it's a lot easier to just say, hey, there's cash sitting in the account. Do you want me to deploy to this? Than wire the money to them and ask them to wire the money back. Who knows what will happen in 3 months? They may have gone and blown the money somewhere else, you know? So did I answer your question, Vessi?
Yes, thank you.
Sure.
Hey, Badri, Tim Little again. So
Sure. Hi, Tim.
what do you see is, and this is on average kind of thing, is the average investment of an investor? Because I think the concern from, you know, a capital raising perspective is that when you have a deal where, you know, the minimum is 50,000, well, guess what? Then everyone's going to put in at least 50,000. But when it dips, when there is no minimum or the minimum is much lower, then people by human nature are going to put much less in. Therefore, you have to create an even broader pool of investors. So I'm just curious to what you're actually seeing in practice in terms of the average amount per investor.
Average amount per investor or average amount per deal?
Okay. Yeah, I guess I would say per deal.
Okay. I'll answer both questions. Per investor, I think I would say it's averaging out to 75, 100,000 or something like that. And per deal, it depends on each fund, right? So some funds have a much higher. So let me step back a little bit. There is a fund level minimum and a deal level minimum, which is completely customizable and it's up to you. In our fund, we've put a very low deal level minimum. The fund minimum to get into our fund is 50,000, but the deal is 5,000 each. That's just our fund. I mean, but we have several funds where the fund level minimum is 50,000 and the deal level minimum is 25,000. So you get to decide on how you want to package that up. But, you know, honestly, over time, yes, in the initial deal, you may not get the initial 50,000. People appreciate the ability to put smaller slices. And we believe you'll attract a much broader range of investors if you're willing to take 10 or 15,000 per deal, as opposed to saying the minimum is 50,000. But if you don't want to, you can still say, hey, the deal level minimum is still 50,000 and the fund level minimum is also 50,000. That's up to you. It's your fund. It's your investors.
Okay, no, and that's good info that you have those different levers that you can pull in terms of the fund minimum and deal minimum.
Yeah.
Thank you.
Yeah, it's completely up to you. I mean, but we do recommend having at least a little, a lower deal minimum than a fund minimum, right? If you said fund is 50, deal is minimum 50, I mean, you need to give investors some advantage to say, hey, we'll help you diversify. But apart from that, and I mean, we are recommending it. It's not a requirement. It's up to you. It's your fund. So
no, that absolutely makes sense. Thank you.
And I suppose even within each deal, you can create a separate class of investor so that when they hit a certain threshold, they get a little bit more. If they hit a little bit lower threshold,
absolutely,
a little bit less. So you can
charge
that as well.
Different fund management fee for different investors based on how much they invest. And here is something also very interesting. Let's say you're raising money for your own deal. You can create, just like you have multiple classes of shares in a syndication, you can do that. I mean, you can do 5 different deals or 10 different deals. I mean, that's a bit too much. I'm exaggerating. Maybe you have a preferred equity deal, and then you have a common equity deal. And maybe you have a 5% pref with the more upside or a 8% pref with less upside. You can do all these different combinations. You'll put them as separate deals. It doesn't take very long to do it at all. And then you can experiment and see, hey, is this really working? If it's not, okay, then remove the deal. No big deal. It's not like you have created a big PPM, right? You can just remove the deal from the platform saying, this pref deal is not working. Let's just go with the common equity. So it gives you massive flexibility to adjust on the fly based on what investors like and what they don't like. So.
Yeah, I can see doing a debt piece and then a pref piece, and then a common equity piece.
And
If
some
it- if it's
combination
a-
too, right? And maybe a lower pref, but a higher common equity, or a higher pref with a lower common equity, or just a plain pref. And you can just change your mind too. I mean, initially, maybe you allocate $500,000 each, but you're finding more demand. Okay, you move that $500,000 to the next, the piece which has the most demand. So
That's
what I
definitely the
don't-
customizable piece of this. So that's fantastic. That's great. A
Yeah.
great way to be able to segment things.
on the fly, right? And the nice thing about this is today, if you want to capital raise, imagine you have to create an SPV, or you so that's a very important piece I should tell you. If you're capital raising for others, there are two choices. You can create an SPV with all the costs associated with creating a special purpose vehicle for each deal, or you can just use the platform which the main syndicator is doing. There are two problems with that. One, you're sending your investors to another portal. And yes, I know the portals tell you that you have multiple logins, but the fact of the matter is the main syndicator has access to your investors, period, full stop. When they issue the K1s, they have access to it. And I can't tell you how many people have come to me and said that, hey, the main syndicator has started marketing to my investors. Now, that might be completely unintentional, or who knows, it might be intentional too, but we won't go there. Here in a customizable fund, you're building your own brand. You're sending people to one place, the same place, as opposed to, here, go to this portal for this deal, go to this other portal for another deal. On top of that, you're giving them a single K1. And you're completely building a brand and a more portfolio relationship with your investors, which you'll never be able to do that if all you're doing is capital raising for somebody. That's point number one. And point number two is it's really cool to be a capital raiser as part of the Avestor platform, because I told you, I mean, just to reiterate what I said, you have the power of all the fund managers jointly negotiating, as opposed to you negotiating one at a time, you know? So I gave you that example where a 50-50 split became a 90-10 split. I'm not saying we get that kind of difference in every single deal, but you do get preferred terms for fund of fund managers. So, and don't worry if, I mean, I'm not saying you have to do only capital raising. You do your own deals, but you interleave it with capital raising deals. Maybe you even interleave it with a simple LP deal. I mean, you're not making as much money, but you're building out your fund management revenue. And you're, more importantly, you're offering a steady stream of deals, at least one deal every month, as opposed to popping up every 8 months and saying, remember me, I had a deal, well, I'm back, kind of a thing, you know? So it really is a good platform for both capital raises and for your own deals. So.
Hey, Badri, I think just for the group, the one thing that I think isn't discussed often enough is that piece that you said about being an LP as a fund of funds, because the problem, you know, as a general syndicator that you run into is the more deals you do, the more responsibilities you have, the more management meetings you're going to, and pretty soon at some point your calendar is going to get filled up with all those responsibilities.
Exactly.
And so the next logical step, or diversion, however you want to look at it, is having a fund of funds that you can use as an LP into those deals, garner better terms because of the amount of money that you're bringing to it, but you're still an LP where you're not doing the work.
The GP work, yeah.
Exactly.
Yeah, where you have to do, I mean, some to be very honest, let's be frank, so many of these capital raisers are pseudo GPs. They're not real GPs, but then they attend some meetings and they're trying to make up some cooked up responsibilities. This is a lot cleaner. So.
Right, exactly. And, so there's a bit of, arbitrage that you have to do as that LP fund of funds, because you still have to make it worthwhile for those investors to come to you, vice going directly to those sponsors, but you are providing a service by vetting the deals, vetting the sponsors, et cetera, et cetera. So as long as you show those investors that you are still providing a service to them,
exactly,
then you still should be good. It's still a workable model.
Exactly. Sometimes it's showing them the service. Sometimes it's raw numbers. I mean, for that 50-50 split and a 90-10 split, even if the fund of fund manager stakes 15%, you're still getting a 75-25 versus a 50-50 or a 60-40 split, So, I mean, everybody wins. So.
Yep.
So I'm just curious, Ismael, you had mentioned a couple of people who you said might be partners. Who among here are potential partners of yours in the fund? I'm just curious. Or you don't want to share? That's okay. Sorry, you're muted.
We have a website where it's the Admirable Group, right? And certainly we started out as joint ventures on individual syndications and have started working enough together where it kind of made sense to work together as a co-GP in multiple deals. And it's a natural progression. So I can say, I got a few of us: Alfredo, Winston, Kelly, Tim. And there's a couple of other folks that are frankly are getting in on some deals as well. And we just structure each deal separately. But I think the natural progression is, okay, we've been working together for a while. We're already leveraging, talent and capability and time. Now it's really this next step, right? And so that I think we're in a good place and to do something like this. So we're excited. I wanted to make sure that they were here to ask questions, and most of the folks here that I can tell are all operators, but even the LPs that see this on YouTube, to give them that flexibility to be able to go see this stuff.
There is entire presentation oriented towards LPs, but they can guess, right? The single K1 and all that. Hey, since you mentioned that, I do want to share one particular slide because that's important. So let me go here. One of the slides is, so what you can do is, there are two decisions you have to make, right? One is, who are your co-fund managers? They're in all the deals, in all the funds, right? So that's like getting married, right? I mean, well, legally you can't marry two people, but let's say, but don't take the analogy too far. But being a fund manager is like getting married. Yeah, you can divorce, but it's kind of messy. So, but what we have is a structure where you identify one or two people who are fund managers and who are managers of the fund, but we do have the flexibility to bring in people who want to just participate at the deal level as in the asset management LLC. So we can create an asset management LLC. So let's say there are 8 of you, 2 or 3 of you are core fund managers, but maybe 2 or 3 of you come in only at the asset management level. So we have that flexibility too. I just wanted to mention it out there. So you're muted again, sorry.
Will you share this presentation with us? This would be good.
Yeah, I'll send this deck too. So
okay.
There are various choices which are possible. We really can accommodate almost any scenario. Just because it's a fund of funds, don't think, oh, then it doesn't work. I mean, we have different legal structures which will accommodate. So I already sent the other presentation, but I'll send a copy of this I'll email a copy of this to you. So.
And Badri, how long does it take from start to finish once we sign up? I mean, anybody wants to sign up with you, obviously there's going to be some Q&A and some of that, but what's your typical timeline?
We recommend 6 weeks, but we have an example of a case where the fund was done in 2 weeks, but don't take that as a given. She was in a real rush to get a deal which was closing before the end of the year. But let me tell you what takes the most time. It's the bank account. Now, you can say, what? I can do a bank account in 24 hours? Yes, you can if it's a regular bank account, but this is a fund of funds bank account, which requires a lot of more compliance checking. And we take care of that for you. We have partnerships with 2 national banks we work with, and with the online access and all that. And we take care of that for you, but we can't rush them. They take a couple of weeks just for the bank account, 2 to 3 weeks. So generally we recommend 6 weeks, but if you really are in a rush for a particular deal, you do your own bank account. I don't know where you do, but then we can try to, that's how we are able to cut it to 2 or 3 weeks. But that's a stretch. 6 weeks is a good, decent time frame. And the other recommendation I would have is, do not wait until you have a deal if you believe this model is correct for you. Not trying to sell you anything, but some people sometimes come in, they have a deal, they're trying to do the fund, they're doing everything at the same time, and it just gets rushed. Think of it like building an empty foundation. Do the fund. I mean, if you're not going to do a deal for a couple of years, it doesn't make sense to do a fund. But if you're actively looking for deals and expect to do a deal in the next 3-6 months, do the fund and have it ready so that you can deploy the deal within minutes as opposed to doing everything at the same time. So long-winded answer to your question, but hopefully, yeah, I answered your question. So
you absolutely did. And this has been fantastic. Badri, I really want to thank you for the time. I like us, right? Where you're doing this and you're getting on these presentations, but not only do you do this, but you actually have your own fund. And so we eat our own obviously it works for you too.
Yeah, we eat our own dog food. I mean, in fact, we didn't, we ran the fund for 2 years. The single K1 is a lot more complex than you might think before we even invited other fund managers. One last thing, I put my information in the chat window. Feel free to, by the way, feel free to reach out if you just want to chat. It doesn't matter if you don't want to create a fund too, but if you just want to chat, or for that matter, if you have a deal which you want to expose to our fund managers, go ahead and send that too. We are happy to evaluate, and we are always looking for deals from our own fund to invest too. Now, we are not going to invest a lot. We invest anywhere from $50,000 to $100,000, but it all adds up, right? So,
I just had one question before you go.
Oh yeah, sure, no problem.
Can someone who lives overseas invest in the fund?
Maybe. So I'll tell you what, it depends, right? So if they get a US tax ID or an ITIN, it's a lot simpler. The answer is yes. If not, if it's just 2 or 3 investors, it's possible to do it. But then you may have to do some tax withholding. Depends on the country. I really am not in a position to give any specific advice without knowing more. It's complex. But the simplest answer is if they have an ITIN and ITIN, a tax ID or a social security, or have a LLC in the US, then they can, no problem. But if you really want to attract a lot of investors from offshore, then it's better if you create a feeder fund, or sometimes that's not maybe the technical word, a fund based offshore. And that's a lot more complex, a lot more expensive. You better be damn sure that you have a lot of investors from a specific country. And you come talk to us, tell us which country, and then we'll work with our attorneys. But we have not done a lot of those, I'll be honest with you. So,
thank you.
Excellent, Badri. Well, thank you very much for your time. And what I want to do is remind the audience what we got going on. Our next show is next year, Monday, January 16th. We're going to have a senior analyst from RealPage who's going to give us a look ahead for real estate multifamily investing in 2023. This is an important time to make sure that we're all tracking what's going on in the future. And as Badri mentioned, yes, even though we may be going into a recession, some will argue we're already going into a recession, people are still going to invest somewhere. They have to, because their money's sitting under their mattress, they're losing money. So I think it's just a matter of making sure that we are aware so that everyone that's on this show can invest where it makes sense. Thank you, everybody. Have a good night.